Good evening, everyone. Thank you for tuning in. I'm Ryan, and with me is Kaiwan. Tonight we'll be going over the 2016 macro outlook.
For 2016, we expect a year of volatilities, and we see turbulence arising from a few key themes. A sharper than expected slowdown in China, as we can see in the last few days. After China implement their circuit breaker, in the first 2 weeks, we experienced China initiating their circuit breaker twice, and then having the China government to suspend the circuit breaker again. So we feel that if there's a sharper than expected slowdown in China, there's going to be more volatilities in the market, and also the weak commodities demand would also result in volatilities and turbulence in the equity market. And lastly, it will be a policy divergence between the US and Europe. We know that Europe is doing their QE and stimulus, whereas US is rising their interest rate. So this policy divergence would also result in the volatilities in the equity market. So for the 2016 outlook for Europe, because of the QE by Draghi, we expect the weak euro to be persistent, and also there is going to be political uncertainty from the refugee crisis, and also not forgetting we still have the Greek debt relief, and the easing of the credits should actually helps the industrial outlook, because a bank would lend out money to spur growth, and the weaker euro would stimulate German export, and also having a stimulus, it would help the corporate lending. So for 2016, the earning growth in the Western Europe, we can see that because of the low interest rate and weak euro environment, top performers are basic material and the financial sector, and also the industrial sector. So from the chart, we can see the front CAC index are actually one of the top performance index in the year of 2015, and the best performers are the basic material stocks, the airline stock, the pharmaceutical stock, and also the REIT stock. As we know from the last 5 years, when US was doing their QE and the low interest rate environment has also spurred the REITs investment in Singapore. And also the Germany DAX 30. The airlines are benefiting from the low oil price, and the construction companies are benefiting from the government stimulus, because due to the low interest rate environment, there's more infrastructure projects going on in the Europe region, and also the air freight and logistics sector benefiting from the low oil prices. And the most beaten stock are the oil and gas equipment provider sectors like Technip SA. We continue to foresee that there's going to be credit risk in the oil and gas sector, and also the automobile sectors, they are hit by the tax emission scandal. So if you look at the Germany DAX 30 index, most of the beaten stocks are the automobile sectors. But however, we see that once the saga blows off, Volkswagen, Daimler are still value buying.